Is this the first sign of the mortgage borrower bailout? Yeah, we're going to be covering that on this week's episode. Then we also have Bank of Canada's study on what happens on variable rates with trigger rates. And I'm going to give you my thoughts on that, on kind of how this is going to impact the market. And then we got a shocking headline from Toronto Star, which says, mortgage interest rates soar at rates we haven't seen since the 90s, which stokes crashing and 10 years of kind of nothing in the real estate market. So is this going to happen to us? And then we got the last polarizing topic. Canada wants to welcome 500,000 people, but can our country keep up? And there's some good statistics in this I wanted to share with you. Now, if you are looking for some help on how to navigate this real estate market, or even right now, a lot of people are starting to get ready for the 2023 market, you can book a call with me using the link that's on the screen. It's right here. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and I run and operate a RE/MAX in the Greater Toronto Area, on top of making wicked, awesome educational content just like this for you. And the first topic we'll be covering today is major mortgage lenders let borrowers shift unpaid interest onto principal to cope with rising costs. In short, negative amortization. And we've talked about this before. This is essentially a quasi bailout. Is this going to be the first that we're going to see? Maybe. So I have some points that I've highlighted here for you. So the first one, it talks about different banks and how they're letting you kind of navigate when you hit the trigger rate and trigger point, right? So depending on which one you're banking with, it works differently. So as of right now, TD and CIBC let you negative amortize. So what that means is most people, their interest payment right now has gone up and is higher than what their static mortgage payment is. So if you're at TD CBC, let's say you're paying $1,000, and then that covers some principal and interest, that amount hasn't changed. But what happened is as interest rates go up, the interest is actually greater than that $1,000. So you're not paying any principal, plus you actually owe money on the interest right now. So that's kind of been happening as rates have gone up. Now, TD and CIBC, and I said this before, you can basically add that interest that you owe onto your mortgage, meaning now instead of paying down your mortgage, you're negative amortizing, you're increasing the mortgage. Obviously, there's a cap. I think it's 80%. So if you're very new on it, like your mortgage, you may not have much room. But if you kind of have a little bit of room, say you had it for 2-3 years, you still got some room to go depending on what your interest payments are. Now, on the BMO side, they haven't talked about it here. But I've spoken to some of my clients who have BMO. They really haven't reached out. So it's kind of still quasi in the air. RBC right now, as long as you kind of pay your interest and you up principal payment portion, meaning like how much you're paying back, increase it by $2, you're solid, right? So that's kind of the lay of the land right now. And I've talked about this before. I think I called out trigger rates in like June, and I talked about how they're dealing with this in September. And it's, kind of like the mortgage to forklift, a little bit of like too much talk about it. It's not really affecting the market. Where effectively every single time we talk about some kind of catastrophic thing that could affect the market and people being delinquent on their mortgages, it just keeps getting kicked down the line. So another bailout. Now, the thing I do want to correct is if you were at Bank of Nova Scotia, which is Scotiabank, right? The interest rates going up has always made the mortgage payments go up, right? So your amortization has always been on time. So your payment has actually gone up. So I don't know why they're calling that part out. Now, over here, this is kind of the shocking thing that I'm going to talk more about in the next article. Basically saying that, there's a lot of mortgages that are over the 30-year amortization, and it's gone up by a lot in the last little bit, which is wild. It is absolutely wild. Now, here's the thing I want to read out to you. Under federal banking rules, right, so OSFI, a portion of the borrower's loan must always be amortizing. But Canada's regulators, OSFI, says that expert lenders' risk management be responsive to changing conditions and practice to adjust accordingly. I don't know, does that scream bailout to you? Because if there's such a big amount of like people over 30 amortization, it's doubled as per the stat over here. That's a lot of people in trouble. Is the government going to just let them kind of ride it out, or are they going to bail them out? If I have to guess, I'm going to go for the bailout side. Now, this is kind of the part that's interesting. It said negative amortizations are allowed if mortgage payment is recalculated once every 5 years to ensure that the loan can be paid out within the mortgage amortization original schedule. So what this means is you're allowed to negative amortize as long as you get caught up on the renewal, which is generally 5 years a term, right, in Canada. So this is, again, we're kicking that can down the road for 5 years. So we're going to probably have a lot of bulk of the big issue ones in 2021 and 2022, where we saw the 1.5% mortgage rate or even less. And that stuff is coming renew in 2026, 2027, right? Which also lines up with a lot of like really expensive pre-con closings. And that's kind of where I think we may have some issues. But at the moment right now, not really. I'd say we just kick the can down the road, like I said, right? Now, the next article we have here, which is kind of what the Globe and Mail article is piggybacking off of. So in Bank of Canada's like study, they're basically saying, and this is kind of some shocking numbers I'm about to tell you. So they're saying about a third of the outstanding mortgage has a static payment, so like a fixed payment that's on variable rate, and about 3/4 of the variable is actually in this bucket. So there's a lot of people under kind of this mortgage. Remember, a third of Canadians have no mortgage, a third of Canadians have a mortgage, and a third of Canadians rent and they don't own a property. That's the general statistics that Bank of Canada came out with. So this is the shocking one. So of the people with variable fixed payments that we're talking about, 50% or nearly 13% or 1 in 8 mortgages have already reached their trigger rate. And this was actually published before the research was done before the October 27 rate hike of 50 basis points. So right now it should be actually much higher. Eesh, that's quite a bit. So 1 in 8 mortgages have hit their trigger rate. That's quite a lot. That's what I'm saying. It could be a bailout time, right? Now, if you kind of look over here, very good charts by Bank of Canada. We kind of gone over here what the chances of you going over trigger rate is. And you can see that we're at the point where we're escalating. It's going to topple over soon if rates continue going higher. But we're getting to the crescendo part of it where like a lot of people are going to be past their trigger points. And this is where it kind of says at the end of October 2022, which is October 27 when the interest rate happened, that 65% of these types of mortgages are going to hit their trigger rate, or accounting for 17% of all mortgages, which is almost 1 in 6. So that's a lot. That is definitely a lot. So what's going to happen, and they kind of go through this, right, which I talked about in the last article about how depending on which bank you have, there's different methodologies of how you can deal with this, right? And here's their conclusion. And I agree with them, right? Now I'll just read it to you verbatim. So, however, this does not necessarily imply that all of these households have had to increase their regular payments as a result, which is what we talked about. Some borrowers may have made prepayments on their mortgage, refinanced their mortgage. That's the key. If you've had your mortgage since like before 2021, you probably had some equity in it unless you refinanced already at the low rate, right? And I don't know if anyone has the numbers for that. So that's kind of where like the percentage of risk is, depending on whether the amount of mortgage you owe is greater or less than the value of your house right now, so market value. So essentially whether you're underwater or not, right? Or they may have switched to a fixed rate or applied other charges since origination that may prevent payment increases. So this is where I would say that people who are very bearish will think that, the market's going to burn down because all these people have hit their trigger rates or whatever. But I think it's just more so of like another kind of deferral cliff where everyone thought, everyone's going to be crazy and the market's going to fall apart because no one can pay their mortgages anymore after the mortgage deferral cliff. But that never happened. And I talked about that in the trigger rates. And the same thing here when we hit the point where a lot of people have hit the trigger rates, even more of them because rates have gone up. A lot of people can refinance or they have money to actually bail them out. The only thing that's a little bit different, I would say, is that we're going into a recession. So if those savings have been depleted, then we may have some issue. But I don't think call it 1 in 6 mortgages right now being passed or hitting the trigger rate is going to affect the market too much. It may add some pressure. And depending on how the media reports this or what the sentiment of the sellers are, whether they can sustain this and where the interest rates are in the new year and spring, that's going to dictate whether prices go up, whether they stabilize or drop down. And that's what I was saying, like we're past the point right now where the market is going to make any noticeable or kind of movements. And what's going to happen is we'll have to see what the spring market brings. And there's so many different factors that could be like, overblown or may stabilize or maybe more buyers come in. And honestly, no one has an answer to that, not even me, right? So if anyone who tells you they have an answer, I think they're full of poo-poo, right? Anyways, if you found this content helpful, make sure you smash the like button and subscribe to the Prime Property channel. And if you are looking for some help on how to navigate the real estate market, or you find yourself in this kind of situation and don't know what to do, you could book a call with me using the link right here. It's www.chatwithzen.com. So I'm going to continue on with kind of this mortgage topic. That's what I'm saying. Like, it's kind of really, really big one. So there's two sides of kind of like how the mortgage negative amortization works, right? So there's the off-C side, which is if you had paid 20% down payment. So you're regulated under those rules. But if you use less than 20%, you would be regulated under the CMHC side, which means you have mortgage insurance. And the bailout is already here. So Sagen, which is one of the companies that provide mortgage insurance, let me just blow this up for you guys, effectively just came out and said, look, if you have stress, right, the current amortization is allowed to be extended up to 15 years to a maximum of 40 years. We were at 30, right, with uninsured. If you did have to go CMHC route, right, meaning you would have to do 25-year mortgage, you are now extended by 15 years. So 25 plus 15 gets to 40. So anybody who bought and call it the last year, even if their amortization started at 25, you can get extended up to 40. Wild, right? So that is going to change your payment a little bit, but obviously you kind of do the math yourself. But that is right there, inherently a bailout, right there. Now, obviously, you have to meet certain criteria, right? Saying that your GDSR must be lower than 39%, and a whole bunch of other stuff. Again, link in the description below if you fit in this category. But basically, Sagen came on and just bailed out kind of anyone who was a first-time homebuyer who paid less than 20% down if their payments are going up. Because if you were forced to sell in those situations, like we talked about before, they would be negative equity, lost money in selling fees, land transfer, and they probably have to pay money to pay off the mortgage. But here is your bailout. And that's probably going to curb a lot of the panic sellers right there. Bam. Canada. Don't you love it? All right, next article here. Mortgage interest costs soar at a rate we haven't seen since the 1990s. Thank you. Stoking fears among other crash. I gotta say, a lot of words using crash. Even if I use the word crash, it performs better. I'm getting kind of tired of this, but let's just go through it. So effectively saying that in the 1990s, interest rates rose so high, 13%. But the idea here is what they're saying is that the percentage of how much income you're earning going towards the house, you have to service it, is getting really high. I think they say it's like something about 63%. So you can see here, I love these Toronto Star things with the poll, and you can see it's not as bad as what people think, right? You got 39% people who don't have a mortgage. You got a quarter of them who have a fixed rate mortgage that aren't too concerned about this. So that means about 60% of them aren't affected by these higher interest rates. Then you got about 30% of the rest of them that kind of are affected. So which kind of fits into the category of a third don't have a mortgage, a third have a mortgage, a third aren't renting, right? So that's kind of matching into the Bank of Canada statistics. And I don't think it's going to be as bad as what some people think because we already have the bailouts that are slowly coming in place, like we talked about earlier, right? And I think the part right here that I did highlight right here, it says that takes 63.9% of income to service it, right? This really depends on how you look at it, right? I think there's some people who are over 100 because interest rates have gone up and they're over levered, but there's a lot of people who probably have a smaller mortgage than what their income kind of pays for, and they could have had a lot of these payments, or they could have had payments to kind of do a lump sum and pay it down. So I think while this average number is shocking, it's probably not affecting the market as much as what most people would want to, at least from the people who are bearish. And then obviously you're here saying that the rates were much higher in the 90s. And then you got Rosenberg coming out saying that, look, it's going to crash as much as 30%, right? In the 1990s, the housing crash lasted for 6 years, taking the market almost a decade to recover. Look, I'm still thinking that there's probably some like price discovery downwards. And we'll find out in spring whether that happens or not. Again, still, like I said, in the early of the fall, best case is stabilize. We're okay. But the worst case is we start decreasing based on rates and sentiment, right? And no one has an idea what's happening with the rates or the sentiment. So I personally don't think we're going to have a lost decade like Rosenberg is saying. I do think maybe we have a year or two of like figuring out what's happening in the market. And because we're effectively backstopped by tons of immigration coming in and a lack of supply. And again, like I've been telling you, interest rates are midterm, long-term, call it 3+ years. I think we're okay. Are we going to get to kind of like the February peak prices? Maybe not, but I don't think we're going to crash another like 10, 20%. Like in the GTA, like I told you, we're already down 20%. I mean, we came back 1%. So technically, like 19% down from the peak, but it's not as bad as what some people are making it out to be. And it's kind of a little bit sensationalized. But again, like, up to you. You let me know in the comment section below. Do you think we're going to see a 90s? I think the people who are very bearish are seeing 90s, but from all the data and talking to a lot of people, I don't think we're going to see something like that of the nature anyways. All right, then we got the last article here. Canada wants to welcome 500,000 immigrants a year by 2025. Can our country keep up? We already said no, and I already of the belief that I think things are kind of breaking, but they're just jamming the people in, right? So I have a couple points where I want to highlight to you, which Globe did some really good research into it. So every single year, Canada adds a big city in a sense, which is absolutely true. For context, right, 500,000 people is the equivalent size of Markham and Richmond Hill put together. Now, when you factor in visas coming in and international students, they said it's 700,000, which is a little bit smaller than Mississauga plopping into Canada. That's how many people we're bringing in. We are not building houses fast enough, right? It's absolutely wild. You can see here, and I 100% agree with this, the push is deliberate. Policymakers make higher immigration unnecessary to fuel Canada's economic growth, and in particular to ease labor shortages that have frustrated the corporate sector. Big problem. So when you boil things down to one data and you don't have context or kind of like explanations of what and how you derive that number, which is GDP, it looks good. So when you bring a lot of people in, our GDP goes up, right? Gross domestic product. But when you look at our GDP per capita, meaning GDP per person, it's going down. So nominally speaking, our GDP is going up because we're just papering over our problems with immigration and letting that number go up. But when you look at it as a per person, it's going down. So the lifestyle that we have in Canada is actually decreasing. It's not getting any better. And that's my problem with how we are kind of, trying to get reelected, right? We just make things look good, but in reality, it's crumbling, right? It's just the first surface number looks good, but things are crumbling underneath. And this is kind of what I think a lot of people are going through when we talk about, roads, police, firefighters, nurses, doctors, the medical system, the immigration system, all this stuff is kind of crumbling, right? I mean, Canada's still great per se compared to other countries, but these are cracks that are happening and we can do better. Now, you can see here, basically, we talked about it, population growth versus housing completions, not even close. That's kind of why we have a housing shortage. Talked about it tons of times before. And here's an interesting number that they put. There are 3.6 new residents for every homes added, the highest ratio since 1991. Very similar to when we had the crash, right? So it's just, is the immigration going to save us? I kind of think so in the long term, but it depends on if people are going to buy it, right? But at the end of the day, if people say, hey, look, immigration isn't going to save us, you have to look at the rental numbers. And if the rents are going up in the big cities like GTA, that means there's a demand for it. People just aren't buying, right? So it's being pushed off to later. So that's kind of, I think, good enough proof to show that immigration is making a dent on the real estate side. Whether people are going to eventually go buy, TBD, right? Because what you can buy depends on how much credit you're being given, right? Most of the time. Now, Canada is facing a complete adjustment. Notably, developers are scrapping or delaying housing projects, and boom. That right there, like we talked about, is if we're not adding supply while we have immigration, because there's a delay, like you can come into the country faster than we can build a home, that's where that number of 3.6 probably increases, right? And like this 3.6 number, depending on kind of like the generational zeitgeist, if people are coming into the larger homes together, then you don't need as much. But if we're building only smaller homes, right, that fits one people, we're building less low-rise homes, which I talked about before, then that means you may not be able to jam that many people into one household formation, right? So, we're going to have to see how things play out. And then the last thing here I have just to show you is immigration is just not good for our economy. It's essential. We can't get by without it, which we talked about. And you can see here, Canada as a percentage versus population, we smoke everybody in the percentage of how many people we're bringing relative to our population. And that's kind of what's, I think, keeping us afloat from a GDP perspective. Is this a good way to kind of fix all the problems we have in Canada? Absolutely not. I do not agree with this. But is this kind of the regime that's forcefully pushing this narrative through? Yeah, unfortunately, that's kind of the thing. Anyways, hopefully this gives you an idea of what's happening in the real estate market. Surprisingly, there's still a lot of news going on, even though we are in December right now. So yeah, just stay tuned as I'll be putting a lot of content for my predictions, how I compare to last year for my predictions. I also got the year-end review because it's going to be a wild one because this is probably one of the craziest years I remember for real estate. And all of that will be coming in the month of December. And if you're looking for some help on how to navigate the real estate market, you can book a call with me using the link right here, www.chatwithzen.com. Until next time, your move, your future. See ya!
Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch the